Amalgamation in the form of merger with intercompany owings. The following were the balance sheet of Bimal Limited and Robin Limited. So complete balance sheet after that. All the bills receivables held by Robin Limited were Bimal Limited acceptances. So Robin Limited's BR is nothing but Bimal Limited's acceptances 80. In Bimal Limited, bills payable being 120. Is that clear? And keep all these things in single page. Right. But these two are not matching. 120 bills payable, 80 bills receivable, 40 maybe NDOTs are discounted. While cancelling, you have to cancel only 80 in both the cases. On 1st April 24, Bimal Limited took over Robin Limited in an amalgamation in the nature of merger. So, Robin will be closed. That too, it is in the form of merger. It was agreed that the discharge of the consideration for the business Bimal Limited would allot 3 fully paid equity shares of rupees 10 each for every 2 shares held in Robin Limited. So, for every 2 shares, 3 is allotted. It was also agreed that 12% debentures in Robin Limited would be converted into 13% debentures in Bimal Limited of the same amount and denomination. Any settlement to the debentures is nothing but a settlement of debt only, is not forming part of the purchase consideration. The expenses of amalgamation amounted to rupees 1 lakh, which is borne by Bimal Limited. Who is he? Bimal Limited being the acquirer. As he pays, this amount will be directly debited to the P&L account in case of merger. In case of purchase method, it may be adjusted either in the goodwill or capital reserve, right? You are required to pass journal entry in the books of Bimal Limited. Prepare Bimal Limited balance sheet immediately after the merger. Between these two, which is the easiest one? B is the easiest one. We can pass journal entry later. Now, how many equity shares are there in Robin Limited? 6,000, right? 10 each. 600 shares are there. For every 2 shares, 3 shares are offered. So for 2,000 shares, how many shares are going to be offered? 3,000 shares are going to be offered at the rate of rupees 10. Sorry, 600 shares. 600 shares, right? 600 shares. 900 shares are going to be offered, and then the value being 9,000. 9,000 is the purchase consideration. Preparation of a balance sheet after the merger is very, very simple. Very, very simple. It's a line by line addition. Line by line addition. Right. Now, what happens here? Land and building 6,000 post merger. Plant and machinery 14 plus 5 19,000. We have to show at its own book value in case of merger. 2,304 plus 1,700, 4,004 rupees. And come on, stock value. Add up these two and get me the value. $3,140 for debtors. Stock value 11,903. BR cancel. Here 80 rupees is cancelled. Automatically ends with 40 rupees. Of course, you no need to pass the entry. If you want to pass the entry, the entry being bills payable debit, BR credit. The debit value being the BR is now cancelled by crediting. The credit value of the bills payable cancelled by debiting. Is that okay? Cash and bank. Come on. 1,007. 23. I can make it 22 by subtracting 1 rupees for liquidation expenses. Ultimately, it will be adjusted in the P&L account also. P&L account also. So this one is also over. Now, in case of debentures, this 12% debenture is converted into 13% debentures, 1,000. And for 6,000, the number of shares or shares worth issued being 9,000. Then this value being 24,000. As you are issuing 3,000 rupees worth the share more than the worth of the share available in Robin, 3,000 excess. If you are paying 3,000 excess, it's a loss will be adjusted in the revenue account, P&L account only. Cross verify. We have around 3,200 rupees. We can adjust the 3,200 from here, 3,000 from here. Am I right? Any excess payment to the equity shareholders, then their book value will be loss. In case of merger method, the loss will be adjusted only in the profit and loss account. In case of purchase method, the loss will be named as goodwill. In case gain, that will be named as capital. So is that clear? Now, securities premium remains unadjusted. Foreign project reserve remains unadjusted. General reserve 9,500 plus 200, 9,700. The 3,000 rupees was already adjusted due to the excess payment to the equity shareholders. Profit and loss account 2,850 plus 775. From that, we can subtract 1 rupee for realization expenses. Ultimate value, come on, tell me. 3,644. So I have incorporated all these things. Now I am going to close the books of account. In case of current liabilities, sundry creditors being 1,080 plus 463. What is the total value? 1,543. Sundry provisions being 2,532. Come on, get me the total of schedule number 1, schedule number 2, schedule number 3 and schedule number 4. Which one? 16,654. Schedule number 1, 16,654. Schedule number 1. Schedule number 2, 4,115. And this one 29,004, 29,004. And this one 765, 16,765. Right. Total 45,769. The answer is pretty simple. The answer is pretty simple. Now we have to close the books of Robin. So to close the books, to pass the entry, you can have this one in your mind so that you can solve this illustration pretty easy. What's that? Of course, not required to prepare the ledger, but at least have this idea in your mind. What is that? Realization account, purchase consideration account, purchasing company being Bimal account, and equity shareholders account. What is the first entry? To close the assets and to close the liabilities, to transfer the equity shareholders funds here. Equity plus resource and surplus. Third entry. 3 entries over. Now we have to incorporate the purchase consideration. Purchase consideration, fourth entry. Purchase consideration payable by Bimal Limited, fifth entry. The mode of offering equity share capital of Bimal, right? So the settlement will be in the form of equity shares of the Bimal Limited to the Robin Limited. Sixth entry. This equity share capital is handed over to the equity shareholders, seventh entry. Finally, on closing this realization account, you'll get the profit and loss that will be transferable to the equity shareholders, eighth entry. So eight entries you have to pass. Now let me start with the assets to be closed. So we have these assets. Right. So which company is going to be closed? Robin. So for closing the assets, realization account debit. Realization account debit to what? What are the assets we have? Plant and machinery, 5,000. Furniture, fixtures, fittings, 1,700. Stock, 4041. Debtors, 1020. BR, 80. Cash and bank, 609. Total being 12,500. The balance sheet I total. 12,500. Balance sheet total. If you don't get, then there is an error. Okay. So I have completed what? Entry number 1 is over. Entry number 1 is over. For the entry number 2, liabilities. For the entry number 3, equities. Okay. What happened? Oh, in the books of Bimal Limited. Okay. Okay then. No. So it's not asked. I surprised that I have to pass entry for Robin. So we have to pass entry for the Bimal Limited. Then it's okay. In case of their company, the entry is same. I don't want to recopy this. So business purchase account debit to liquidator of Robin Limited, the value being 9,000. Second entry, assets taken over, plant and machinery debit, furniture, fixtures, fitting account debit, stock account debit, debtors account debit, BR account debit, bank account debit. The value being 5,000, 1,700. We have to show at book value 40, 41, 10, 20, 80, 609. 609. Then I have to show the resource and surplus. Here what happens? To foreign project reserve 310, to GR 200 rupees, 3,000 adjusted in 3,200, so we have only 200. Profit and loss 775. Profit and loss 775. 1 rupee will be adjusted while settling the payment. 775. Apart from that, 2 creditors 463, to provision 702. We have 12% debenture. Right here 12% debenture. Then what you offer for the 12% debenture in exchange can be passed as a fresh entry. 12% debenture credit later on 12% debenture debit to 13% debenture, but rather than you can directly post here 13% debenture instead of that. How much is that? 1000 rupees. 1000 rupees. Clear? Next settlement entry, liquidator of R account debit to equity share capital of this company 9000. Settlement over. The next entry being BR-BP cancellation. BP is cancelled by debiting. BR also cancelled by crediting. While doing so, the lower amount of these two will be cancelled, 120 and 80. We already cancelled only 80 extent. So the bills payable in excess of this 80, 40 may be understood like maybe endorsed or discounted. Now we have to settle the liquidation expenses. For settling the liquidation expenses, it can be debited to the P&L account. So P&L account debit to liquidation expenses bank. This value being 1 rupee. 1 rupee. Is that clear? Hope now you will be able to understand. Okay. Here, two business purchase. 9000. Okay. Shall we move on to the next one? Question number 3. Question number 3. Question number 3. The specialty of this illustration is equity share capitals are issued for debenture holders. Anything used for settling the debenture holders is part of settlement of debt only. It's not part of purchase consideration. So it will not be included in the purchase consideration. ABC Limited and PQR Limited decided to amalgamate on 1/4/2024. Amalgamate. Okay. Amalgamate ABC and PQR both will be mingled. If nothing stated, you can assume it is a purchase method only. If it is specifically stated only, then you can go for the merger method. From the following information, you are required to prepare a balance sheet as on this date of a new company NCCI Limited. What's that? You have to prepare the balance sheet, which was formed to take over the business of both the companies and took over all the assets and liabilities. So you are asked to prepare only the balance sheet. No journal entries required. Right. 50% debentures are to be converted into equity shares of the new company. 50% debentures are converted into equity shares. Out of the investment, 20% are non-trade investments. Fixed assets of ABC Limited were valued at 10% above cost and that of PQR Limited at 5% above cost. 10% sundry debtors were doubtful for both the companies, stock to be carried at cost. Preference shareholders were discharged by issuing equal number of 9% preference shares at par. So any payment to the preference share capital is a part of purchase consideration. And equity shareholders of both the transferor companies are discharged by issuing equity shares of ₹10 each of the new company at a premium of ₹5 per share. Okay. So this is also part of purchase consideration. Right. Now find out the purchase consideration. The amalgamation is in the nature of purchase. It's also clearly stated. Now, what method you have to follow? Is it net payment method or lump sum method or share exchange rate method or net payment method? So, what method you have to choose here? If you are not clearly find out based on the offer made by the purchasing company, it is not considered as payment method. Preference shares, okay. Equal number. How many number of preference shares are there will be equivalently issued in the new company also, then okay. But in case of equity shareholders of both the transferor company are to be discharged, then I'm not sure how many number of shares are going to be discharged. So naturally what happens, you have to go for net assets method. You have to calculate the assets value based on the realizable value and subtract the liabilities value. Whatever the ultimate value you know, for that you have to offer the shares. The share value being 15 rupees. Overall purchase consideration divided by 15, so number of shares offered will be found out here. Now I need to know the values of assets and liabilities. Here, assets, we have been given, these are the set of assets. Okay. Debentures are to be converted into equity shares of the new company. 50% debentures. Right. That you can incorporate only in the purchasing company, not here. Not here. Here he just takes the debenture as it is and finally he settles. In the previous illustration we have seen here, right? 13% debentures is issued instead of 12% debenture. It will not have any connections there, okay, in the selling company. Here you can pass this way also, 12% debentures, later 12% debentures are on debit to 13% debentures. So you consider that you are taking the debenture as it is. Later, their debenture is going to be cancelled by offering your own either debenture or equity shares. Then 12% debentures to the offering you do. So in this illustration, you can combine these two entries as a single entry. The same way in the new illustration, you take the debentures. How you are going to settle that? By issuing the equity share capital at least 50% of the value. So you take this and later on you can settle this. Right. Now, fixed assets of ABC Limited were valued 10% above cost and that of PQR 5% above cost. Fixed assets. Fixed assets. Okay. 10% above cost. Here 5% above cost. Clear. Sundry debtors were doubtful for both the companies. 10%. Minus PDD being 10%. PDD being 10%. Now, out of the investment, 20% are non-trade investment. Non-trade investment. Clear. So, among these three, these two are called fixed assets. Investment may be temporary purpose, it's not clearly stated. Out of this investment, 20% will be considered as non-trade, rest will be considered as trade. Based on their trading activity, it may be short term. Okay, maybe their own trading concern. You no need to incorporate there that one anywhere in the calculations purpose. It's for understanding purpose, not the classification purpose. Now you can find out the purchase consideration for ABC as well as PQR Limited. Right. So what we have to do? You have to prepare only the balance sheet. Only the balance sheet. So my duty is to find out what? Purchase consideration and then directly go for balance sheet. Building value for ABC and for PQR. For ABC, 60 plus 10, 66,000. For PQR, 50,000 plus 5%, 52,500. In case of plant and machinery, 80 plus 10%, 88,000. 70 plus 5%, 73,500. I consider that investment being not fixed asset. Maybe for their investment, regular trading purpose or non-trade purpose, only 20% seems to be non-trade. So you can calculate the rest as it is. Okay, 40,000 rupees and 25,000. Even you can give the conclusion to the extent of 20% is trade investment, non-trade investment. Non-trade investment can be assumed to be fixed assets. On that 10% is inflated. That way also you can assume and give the note. Else you go with the omission of that part completely. And current assets stock. No change in stock, 36,000, 40,000 rupees. In case of debtors, PDD should not be subtracted from here. You have to show its value fully, 45,000, 35,000. How can I show that PDD, sir? That will be separately shown along with the liabilities, right? Because PDD is not to be deducted from the debtors. It's only a provision you are creating. Some X or Y from whom we have to recover around 10 to 15,000 rupees. We have a slight doubt, so we create a provision 5,000 rupees that X may not pay. So if you create a provision 5,000 that we cannot recover it from X later on, if I subtract from the due of X later on, he calls me asking me about what's the due I have to pay. As per your books, then it will be net of that provision. So you have to be double cautious. So for example, X has to pay me 10,000 rupees. As I have the doubt, I created the PDD 50% 5,000 rupees. Now the amount recoverable from X being 5,000. It's my doubt. Doubt is subtracted from the value. Surprisingly, X may win a lottery, becomes crorepati. The next day it gives me call. How much I have to pay? If you show only 5,000 rupees in your account, the amount recoverable from X, you say, sir, only 5,000. He is very happy to settle this. So you have to show the 10,000 as it is, doubtfulness as it is. When he calls, you say, sir, 10,000 you have to pay. Okay, I will pay. Then doubtfulness will be now cancelled. Then you are pretty happy. So whenever there is a PDD, it should not be adjusted in the PDD. It should be separately shown. Separately shown. Clear? Hope now you'll be able to understand the logic. Then bank. Then bank. 40,000. 25,000. What is the total value of the assets? 3,15,000. Am I right? And here 2,51,000. Now creditors. What happens here? Creditors. Yeah. How much is the creditors? 25,000, 15,000, and tax provision is there. Tax provision. The value being 7 plus 4, 7,000 and 4,000. PDD for this 10% 4,500. For this 3,500. What is the total of liabilities to be subtracted? 36,500. 22,500. Now what about the net assets? Net worth, asset minus liabilities. 2,78,500. Am I right? Here 2,28,500. Am I right? Yeah. Calculate and tell me. Huh? In liability, I have missed the debentures also. The debenture value being 50 and 30. 50 and 30. 50,000 and 30,000. Then it is 86,000. If you add 30, so 52,500. If we subtract 50, then it is 28,500. And this is 1,98,500. 1,98,500. And this is what about your purchase consideration. The purchase consideration is offered by way of preference share capital as well as equity share capital and securities premium. Is that okay? Preference share capital being equal number, the same value will come 30 plus 20. For him 30,000 rupees. For him 20,000 rupees. Now amount meant for the equity share capital being 2,28,500 divided by 30,000 divided by 15 will be the number of shares. Is that okay? I will work out that here. Divided by 15. Come on, tell me the number of shares. You subtract these two and then divide. 2,28,500 minus 30, 1,98,500 and divide that by 15, you will get 13,233.33 shares. Then there is a fractional share can be settled by way of cash. And in this case, 1,98,500 minus 20, 1,78,500 divided by 15, 11,900. Now equity share capital will be multiplied with the 10 rupees. This is with 5 rupees. Okay. So 13,233 into 10, 1,32,330. Securities premium 5 rupees on that. 66, 165. And 0.33 fractional share, one share's worth being 15. So you have to multiply 0.33 with the 15. Okay, 0.33 with 15. So 5 rupees. Okay, then in this case, 11,900 into 10, 1,19,000. Here, 59,500. No fractional share, no cash payment. No fractional share, no cash payment. So then you are asked to directly post what? Balance sheet. Okay. Now, in case of debenture, 50% is settled. In case of debenture, 50% are to be converted into equity shares. Remaining will be the same debentures. So, for that, I am going to calculate separately for the debentures. For the debentures. Is that clear? Now, what happens here? I will calculate that here separately. For the debenture, 50% is converted for ABC, for PQR. Debenture converted into equity share capital. How much? Out of 50, 25,000. Out of 30, 15,000. Number of shares offered. The shares in this case being at the rate of 15. Divide this by 15, you will get the number of shares here. Come on. Clear? 1,666.67. Here 1,000 shares. This is what about the number of shares. Then what about the equity share capital's worth face value? You have to multiply with the 10. 1,666 into 10. 16,660. And here 10,000. Securities premium being 5 rupees. 8,330. 5,000. 0.67 is a fraction, for that cash is used. 0.67 into 15 rupees. 10 rupees is the payment. Alright. After the amalgamation, the new debenture balance being 40. 50% cancel, balance being 40. Rest of the things we can directly post here. Investment allowance reserve 7,000 will be retained here, or 0. Is 0. But you have to show this way how amalgamation adjustment account 7,000 and to what? Investment allowance reserve 7,000. Put the value in the inner column. So this will be in an inner column. This is inner column negative. Automatically it becomes 0. Right. Sundry creditors value being 40,000. Tax provision being 11,000. Debenture got totally cancelled. PDD being 8,000. So the total value 80 minus PDD 8. ultimate value being 72,000. Right. Building, 1,21,000. How much is that? Come on, 1 lakh. Yeah, 1,18,500. Plant and machinery, 1,61,500. Investment value, 65,000. 65,000. Stock, 76,000. Bank, 40 plus 25, 65. Two payments were there. This payment, 5 rupees. This payment, 10 rupees. 15 rupees were paid off. So the ultimate value being from the 65,000, you have to subtract 15 rupees. 64,985 will be the value. 985 will be the value. Is that clear? Now, I am going to incorporate completely for the shares. Yes. For the equity share capital, you know how much is going to be offered. Get me the total of this one. Okay. I will underline the equity share capital value. This one and this one. You have to add up all this value and tell me the value. Is that okay? Shares offered to the equity shareholders as well as debenture holders, both put together. 2,77,000. Yeah. 2,77,990. The premium will be half of that. How much is that? Half of that will be a part of reserves and surplus. I'll put the value here, reserves and surplus. Securities premium, half of that. Come on. 2,77,990 being 10 rupees, premium being only 5. Half of this face value will be the premium. 1,38,995. Is that clear? Then we have to go for the preference shares. For the preference share capital, 30 plus 20, 50,000 is offered. Means the same preference share value remains. But rather than the preference share capital of ABC and PQR, now they will hold the preference share capital of NCCI, the new company. Right. I have posted all these values. Now, nothing is there left over unticked. In reserves and surplus, now come and total the schedules here. In reserves and surplus, we have the total being 1,38,995. But in schedule, you have to show this one also. Put the value 0 in the outer column. And this value being 51,000. This value being, come on, 3,45,000. And final value 12,985. All this value I am going to post in the main book. Okay, main book. For schedule number 1, 1,38,995. For the schedule number 2, current liabilities 51,000. For schedule number 3, non-current assets 3,45,000. For current assets, the total being 2,12,985. If I ask you, what about the profit and loss by amalgamating? If there is any profit or loss in amalgamation and the purchase method, it will be posted in goodwill or capital reserve. Come on, do you have any profit or loss here? Tell me. So you can easily find out by tallying this, totaling this. If the total is not there, definitely you can find out the goodwill or capital reserve. But remember, under net assets method, usually you don't get any goodwill or capital reserve. What the company is worth we calculated by using the net assets method. For the worth we are offering exact value. Definitely we no need to have any gain or loss here. So when you cross verify, you tally the assets and liability side, it will be definitely tally. Clear? Come on, tell me. 5 lakhs. In book I have given the different value. Okay, 5 lakhs. Okay, in book there is a total mistake. Okay, 5 lakhs 57,985 is the correct one. Clear? Hope now you will be able to understand. See, we are able to solve in a matter of 15 minutes. Every illustration can be solvable in a matter of 15 minutes. In case of examination purpose, you need to answer only the things asked in the exams. Okay. Shall I move on to the next one? Now, this question is one of the interesting illustrations. Most probably this question is not available at the foundation inter level. I have seen this illustration at final level. Anyhow, I just incorporated for your better understanding, because until now you might have studied 4 ways of purchase consideration: lump sum method, and net assets, net payment, and share exchange ratio method. In practical life, we don't have only these 4 methods. We have a number of other methods also. In CMA final, no, you have a paper called business valuation. So in that business valuation, while amalgamating 2 companies, first of all, you value the transferor company's worth and transferee company's worth. And based on that, then how can we value? We may use a PE, profitability, PEG, book value. Not only book value, we have a number of methods. Probably the book value may be 10 rupees for company A. The book value of the company B being 15 rupees. This is what about the book value per share. But the EPS being for this company 5 rupees, for this company it's only 2 rupees. So until now we fixed the share exchange ratio based on the book value. Net assets method per share. Based on that we will calculate. So 10 is to 15. Otherwise 3 shares. Otherwise 3 is to 2. 3 shares are offered for 2 shares of this company. But this company's earnability is higher than this company's earnability. Then what do you have to do? You have to find out based on the earnability. No, though the book value is lesser, but this company is capable of earning better. So such a way, the evaluators, the valuers, to decide how many shares can be offered will have their own perspective, their own logics that will be totally different. So in those cases, you need to apply 3 or 4 models, and among the 4 or 3 or 4 models, the best or average may be taken. That will you will study at your final stage. Okay, and practical life also you will have the same type. For understanding that maybe other part means other methods also available, I have incorporated this illustration. Very rare for your inter exams. Purchase consideration based on profitability. It's okay. Apart from that, I have incorporated intercompany owings also. Clear? Now, Star and Moon had been carrying on business independently. They agreed to amalgamate and form a new company, Neptune, with an authorized capital of rupees 2 lakhs divided into 40,000 equity shares of rupees 5 each. On December 24, the respective balance sheets, fixed assets and current assets, current liabilities representing capital. So they have not given the complete broken up balance sheet, only a condensed balance sheet is given. So our intention is not to study what is there in the balance sheet. So our intention is to understand the share exchange ratio based on the profitability. Additional information, revalued figures of fixed and current assets are given here. The debtors and creditors include 21,000 owed by Star to Moon. So it is called intercompany owings. Then it can be very easily cancelled by debiting the creditors and crediting the debtors. This value will be eliminated in both the cases. The purchase consideration is satisfied by issuing the following shares and debentures. 30,000 equity shares of Neptune Limited to Star and Moon in proportion to their profitability of their respective business based on the average net profit during the last 3 years, which were as follows. So 30,000 is the equity shares, right? So number of equity. So total number of shares being 40,000 authorized capital. Out of that, 30,000 equity shares are planned to be given to Star and Moon. To how much equity share capital is offered to Star and Moon will be decided based on the profitability ratios. So year 2012, they have profit in Star and Moon, and 2013 loss for Star and profit for Moon, and 2014 profit. Apart from that, 15% debentures in Neptune Limited par to provide an income equivalent to 8% return on capital employed in their respective business as on 31st December 2014 after revaluation of the assets. Right. Now, first you calculate the average net profit. What is the profit here? Total of the 3 year. Come on. Total of the 3 year. And take the average also. Take the average directly. Divided by 3. 1,37,500. What about Moon? Is that okay? So Star and Moon. Star and Moon. What about the equity share capital offered to them? They plan to offer 30,000 shares at the rate of ₹5 each. 1.5 lakhs. Okay. Will be offered in this ratio. 1375 is to 1625 ratio. Come on, distribute this. If you share this 1,15,000 in this ratio, what is the amount for Star? 68,750 rupees worth the share for Star. 81,250 worth the share for Moon. Am I right? Number of shares being 30,000 rupees, 30,000 shares, right? 30,000 also segregated in this ratio. I think it is 3,000. 10 exists. Then 13,750 shares, 16,250 shares, per share 5 rupees. So you multiply this with 5. You get this one. Equity share capital. Purchase consideration is settled by way of not only equity shares, also debentures is also paid. Also debentures. Okay. So debentures. 15% debenture is offered. Anything offered to the equity shareholders, even though it may be debenture, also part of purchase consideration. So already equity share capital is also offered. Apart from that, the equity shareholders of Star and Moon are guaranteed with a minimum return. How? In their own existing company, what could be their net assets worth? No, for that 8% return is guaranteed by offering the debentures. As you are being the debenture holders, you will be guaranteed with the interest rate, 15%. The 15% interest rate is offered in the debenture, which is equal to 8% on your return, your investment. It means the way how you calculated earlier for debenture exchange, right? So you applied what? That old rate divided by new rate divided by old rate formula you use, right? The same amount of interest should be available even after issuing the higher rate of debentures. The same logic. For example, here, what is the net worth? We have to find out the net worth first of all. Net worth after the revision. Fixed assets of Star and Moon. This one 3,55,000, 1,95,000. Current assets 1,49,750, 78,875 here. Total being 5,04,750 here. Two lakhs 73,875. And current liabilities in this case being 2,98,500, 90,125. Now investment. So capital employed. Capital employed is nothing but assets minus current liabilities. Owner's fund. Come on, tell me what's the value. 2,06,250 will be the capital employed. Here 1,83,750. What happens, they will be getting at least 8% return on their capital employed. Guaranteed. How the guarantee will be available? If the debenture is issued, then definitely there is a guaranteed interest. Now, debenture at the rate of 15% will be issued. How many number of debentures are going to be, or what's the worth of debenture is going to be issued? You multiply with 8% divided by 15% with this value. Come on, get me the value. 1,10,000, 98,000. So you know that you are being the debenture holders where the debenture carries 15% interest. Your interest return could be how much? 15% on this. Come on, tell me. It is for additional learning. It is for additional checking up. 16,500. 14,700. What about the investors' expectation? In their capital employed, they need to get 8%. For 2,06,250, 8% being 16,500, 14,700. Is that okay? So whatever the leftover capital employed they have now, for that they need to get 8%. How can I guarantee that? So the company guarantees by issuing the debentures which carries 15%. As the interest rate for the debenture is higher, definitely they can issue lesser number of debentures. For that, 8% divided by 15% will be used for multiplying with the capital employed to get the number of or value of the debenture issued. So 1,10,000 and 98,000. So 1,10,000, 98,000. Now find out the purchase consideration. 1,78,750, 1,79,250. This is what about the purchase consideration. Clear? You got the purchase consideration. Compute the amount of debenture and shares to be issued to Star and Moon. We have completed. A balance sheet of Neptune Limited showing the position immediately after amalgamation. So you can now prepare the balance sheet immediately after the amalgamation also. Okay. Now, so what happens here? Fixed assets being this much, 3,55,000 plus 195, overall value being 5,50,000 rupees. Am I right? Fixed assets. In current assets, you have to subtract this value, and current liabilities also you have to subtract this 21,675, isn't it? Come on, get me the current assets value. You add up these two and subtract this one. 950. 2,06,950. Fixed assets we have completed. Current liabilities. Current liabilities being 3,66,000, 4 3,66,950 will be the current liabilities. 7,56,950 is the assets total. Current liabilities is this one. Representing capital, beforehand we have the debentures, 15% debentures and equity share capital. 15% debentures being 1 lakh, 2 lakhs 8,000. Am I right? Equity share capital being 1,50,000. 1,50,000. Now total the liability side. Hope you will be getting the value matching with the assets total. Okay. Fixed assets 5,50,000. Current assets 2,06,950. And current liabilities being 3,66,950 after eliminating intercompany owings, and representing capital earlier is now replaced with the debentures as well as equity shares. Equity shares for these two company being 1,50,000 and debentures for these two company being 2,08,000. 7 lakhs? Which side? Asset side. It means you are paying more than its worth. If you are paying more than its worth, they may be named as goodwill. Oh, you are paying lesser, then it may be named as capital reserve. Okay. Capital reserve. What's the balance here? 32,000 being the capital reserve. You are paying lesser than their worth. So capital reserve.